And keep going on afternoon. Chapter 2. We're going to talk about again with the cost and cost terms and what's happened with the costs. And we're going to talk about some perspective here, which will define the cost and for the different purposes. First purpose is classification of the manufacturing cost. Let's pretend we're a manufacturing company and we want to manufacture a product. What kind of costs we need to have in order to have a product? We need to have three costs. One is direct material, the other is direct labor, the third one is manufacturing overhead. What that means, direct material will be the raw material, which eventually is going to become an integral part of our product, can be easily identified, easily be traced directly to the product. Direct labor. Direct labor is, again, that will be the labor for the workers that can be easily and directly identified and traced to the product. Now that's raised the question, what's we going to have with, do we have materials which cannot be easily traced? And do we have a labor cannot be easily traced? Yes, we do have those one. And those one, what we're going to do with those? We're going to call them not direct, indirect. Indirect material, indirect labor. So where are we going to categorize them? We're going to put a new category, which is going to called manufacturing overhead. So manufacturing overhead, that will be the cost which are related to the product, but cannot be directly and easily appointed or identified or measured. What will be also included besides the indirect material, indirect labor, we're going to also have some other costs which are related to the utilities for rent, security, insurances, depreciation, and all those different type of costs which are related to our product, the production of the product, but not can be easily or directly identified. And that brings us to the classification of these three costs: direct material, direct labor, manufacturing overhead. So since direct material always come first and direct labor follows the direct material, we're going to call direct material, direct labor prime cost. Prime means first. And we're going to call it prime cost. Then we're going to have direct labor. We're going to pull direct labor and manufacturing overhead together. So those two together will be our conversion cost. Why they call conversion cost? Because they're converting raw material into the finished product. So for that reason, direct labor and manufacturing overhead will be conversion cost. But on the other hand, direct material and direct labor is going to be prime cost. Why? Because they're coming first in the process of production. What we're going to do with the overtime? Overtime will be manufacturing overheads. But for some reason, specific overtime can be treated as a part of direct labor. That's with the manufacturing cost in which is related to the product. Is there any other cost in the company? Of course, there are other costs. What will be that? Non-manufacturing cost. What will be that? That related to the product, but now they're related to the marketing and selling of the product. So those will be directly expensed, and we're going to have administrative costs, which are costs for the organization itself. And that brings us to the two types of costs which are based on the product in manufacturing company or any company that will have product cost, which product cost we're going to include direct material, direct labor, manufacturing overhead, and we're going to have a period cost, which will be directly expense. So not that the product cost not going to be expense, don't get me wrong here, but they're not going to go to the expense in the income statement as expense. In the contrary, they're going to go, they're still going to go in the income statement, but they're going to come now as a cost of goods sold. Why do we need the cost of goods sold? Because we want to calculate the gross margin that we're receiving from the single product that we're selling. So, but as long as we have that product in our inventory, it's going to stay on the balance sheet. Once the product is sold, become part of the cost of goods sold or income statement. So that's how we're going to differentiate the cost based on the which financial statements they belong to. There will be product cost and there will be period cost. Let's see which one of the following costs will be considered period rather than product cost in the manufacturing company. Now, the easiest way is here to determine which one is period versus product. Anything which is related to manufacturing or production, it's going to be product cost. I believe we already did this, but let's do it again. Repetition is good. So let's go. Manufacturing equipment depreciation. What kind of cost is that? Product cost or period cost? What do you think? Product cost. On the product cost, direct material, direct labor, manufacturing overhead. Which cost is that? Is it direct material? Manufacturing equipment depreciation. Is it direct material? Yes or no? Direct material. Equipment depreciation. No, it's not. Can you, question for you. Can you go to the kitchen and bring me the depreciation? Are you sure you can't? Can I go to the store and say, buy some depreciation? And I say, you go to the store and say, I want to buy some equipment depreciation today. I need £5. The broken plates, that's a wastage. That's not a depreciation. So obviously it's not. Okay. So depreciation is cost of the asset, which is transferred the life of the asset. Why are we transferring that cost? Because we're using the asset to manufacture product. So is it a product cost? Absolutely, it's product cost. Is it direct material? No, it's not. It cannot be easily traced to a single product. Is it direct labor? No, it's not direct labor, so it'll have to be manufacturing overhead. Let's go with the property taxes on the corporate headquarters. Is it product cost or period cost? Period, because it's for the corporate quarter. What if it says property taxes on the production facility? Manufacturing overhead or product cost, okay? Direct material cost. It's very hard. It will be very hard to make a mistake with direct material cost. That will be product cost. And more specifically, will be direct material, right? How about the electrical cost of the light in the production facility? Manufacturing overhead. What if it says on the headquarter, electrical cost for the light for the headquarter? Period cost. Okay. Sales commission. What we're doing with sales commissions? Period cost. Okay, good. All right. So that's what it is. Those are the period costs. So now let's go with the type of businesses that we may have. Now, in North America in general, and everywhere in the world, we can categorize three main type of business. One is the service business, dealing with service and service only. The other one is the merchandising, and the third one is the manufacturing. Merchandisers, now you have wholesale and retailer in North America. In the other country, there's a different story, but that's how the organization is here in North America. Now, what's interesting with those, the interesting thing is the service company, they'll provide service. Not much inventory there involved. Merchandise, on the other hand, what they're going to do, they're going to buy finished goods, or they're going to buy a inventory or merchandising inventory, and they're going to sell the merchandising inventory. But they're not buying the inventory because they like the inventory too much or because they use it. They're buying it for only one reason: to sell it. That's why it's called merchandise. Manufacturer, on the other hand, they don't have the product, but they're the one who create the product. So in order to create the product, they have to incur all the costs: direct material, direct labor, manufacturing overhead. So they have to start from somewhere by buying raw material first, and they have to produce it. The question is, how are we going to get cost of goods sold? First, let's see what kind of accounts we're going to get in this company. In the merchandising company, we're going to have only one inventory account, will be merchandise inventory. There will be different subcategories of merchandises, but in general, there will be only one merchandise inventory, that's all. So every time when you see merchandise inventory in the name, that means merchandising company. Is it going to be Whole Foods or a retailer? That's a different story. On the manufacturing company, however, we're not going to have a merchandise inventory. Then what we're going to have? We're going to have three accounts now. Don't forget, we have to produce the inventory. So we need a raw material, we need a work in process, and we need the finished goods. Raw material, okay, raw material, because we have to get the raw material, then convert it into the finished goods. Why do we need the work in process? Well, we need the work in process because we have a reporting period, people. And you cannot tell the people, you know what, my reporting period comes 5 days before the reporting period. Guys, stop getting new material. I want all the products which are already started to be completed in the next 5 days. And if you finish early, no new material, take it. We're just going to have a party until the end of the month. And next month, we're going to start producing again. That's not going to happen. So in order we not to interrupt the process, we're always going to have some products will be half finished, half not finished, and those going to be in the working process. And then when we're producing, that's going to become a finished good. Now the question is, from where we going to get cost of goods sold, which we need for the income statement. For the income statement, before we go to this, I'm going to open here one Excel spreadsheet. I hope the Excel's not going to give me trouble. I don't have to register again. No, I think I'm good. And I'm going to share my screen with the Excel spreadsheet, and we're going to start doing some calculations here on the Excel spreadsheet. So that's the Excel spreadsheet. I'm going to make it a little bit bigger like this, and I'm going to start working here. So let's pretend we are a merchandising company. And we have only one inventory account, which is called cost of goods inventory, merchandising inventory, sorry. So what we're trying to get, cost of goods sold. Why do we need the cost of goods sold? Because we need to calculate our gross margin. Who's going to look for the gross margin? Obviously, that will be the investors or creators or people who are involved in decision making. So we're going to have inventory account, and that from that inventory account, since it's we're going to have here debit, the other side we're going to have credit, the account I'm opening here. That inventory is balance sheet account and asset account. So beginning balance going to be on debit side, and the ending balance going to be on the debit side as well. And that's our account. Boom, done. Our account is set up. So we have inventory account. Now, on the debit side, obviously, it's going to have increases. Here's going to be increase and increase. Note that is C7, increase and increase. And on the credit side, it's going to be reduction, reduction. We already know that. We don't have to keep going with this basic accounting stuff. That's for the baby accountants, not for us, right? So the question is, I open the company, so basically on the income statement, I want to see sales. And once I see the sales, those sales come with cost. I want to see cost of goods sold. From where the cost of goods sold is going to come? In the merchandising company, it's very simple. They're going to come directly from the inventory account. Right from here, we're going to have this flow of cost of goods sold, which come in directly from our inventory accounts. So any reduction of the inventory account is going to go to the cost of goods sold. The only thing that you have to make sure is the selling above the cost. So if the cost is $50, make sure at least you get 100. And that's going to give you a gross margin of $50. Why gross margin $50? Because after that you have to cover the operating expenses, but we're not going to go that deep. Now, our objective is to get cost of goods sold. How can I get the cost of goods sold? From the inventory account. In the inventory account, obviously, we're going to have a beginning balance. We're going to have a debit, which is on the debit side. In order to bring debit in the inventory, we have to purchase. We may try different activity, but only purchase of the merchandise is going to give us more inventory. On the credit side, we already know that's our cost of goods sold. That's what we're trying to find out at the end of the day, how much is the cost of goods sold, so we can show it as a number in the income statement. And we're going to have ending balance. What's interesting with this type of accounts, which is a balance sheet account, asset account. Interesting part is the beginning balance plus the debit. It's always equal to the credit plus ending balance. But hold on a second. Our debit is actually called purchase. And our credit is actually called cost of goods sold. So can I call debit something else? Yes. I can call it whatever I want. I can call it sales, or I can accounts receivables not paid, or pay, anything like that. There's so many options that on different accounts we can call debit different things. How about cost of goods sold? Yes, on different accounts we're going to call it different things, but that doesn't change the fact that one is on the debit side, the other one is on the credit side. For this particular purpose, for the inventory purpose and calculation of the cost of goods sold, we're going to know that for the inventory, we need to purchase the inventory. So that debit that's coming in that account always going to be purchases coming from the purchases, and whatever goes on the other side, on the credit side of the account, that's where we're going to be. That's from where we're going to get the cost of goods sold. That's our objective, to get this cost of goods sold, to see are we going to generate gross margin or not. So if I know my beginning balance, let's say my beginning balance is 20. I know my purchases is 100. And I know my ending balance is 30. Can I calculate? Is it possible for me to calculate how much will be my cost of goods sold? That's the question. Well, how hard would it be? What we don't know, when we replace on this formula, we're going to have beginning balance plus the purchases. It has to be equal to the cost of goods sold plus ending balance. Well, I know my beginning balance. My beginning balance is 20. So that's 20 plus my purchases are 100. My ending balance, so on the other side of the equation, I'm going to have cost of goods sold, which I don't know, plus my ending balance, which is 30. So what we can do, I can easily find that my cost of goods sold are equal to, that will be equal here, 20 plus 100 minus 30. My cost of goods sold are 90. So cost of goods sold are 90, and if we keep the same ratio, let's go with 180, so making exactly the same cost of goods sold. So that's how we calculating cost of goods sold. Now, can I present this calculation? Now, as you can see, this calculation is on the horizontal way. Can I present it vertical? Yes, we can. And if we do it, that will be called a statement of cost of goods sold. So what we're going to start? First, we're going to start beginning balance of the inventory. Then we're going to add purchases. Then once get the beginning inventory plus the purchases, I'm going to have inventory available, not for usage. We're buying for only one reason, the inventory, to sell it. So inventory available for sale. Otherwise, we don't need inventory. Why do we need inventory? We just want it to so we can sell it, so we can generate profit. We're just buying and selling, nothing more. So once I have the inventory available for sale, what I'm going to do, I'm going to deduct less ending balance of the inventory account. And then that's how we're going to get cost of goods sold. And my cost of goods sold will be here. And we can double space it and make it nice and beautiful. So that's the calculation of the cost of goods sold. So if you want to present it, put the numbers here. What we have to do, let me first extend this one a little bit more. And we can put some numbers so we can see if this makes sense. So our beginning inventory was 20. We purchased 100. Now we have available for sale 20 plus 100, that's 120. And then the balance is 30, which is going to be cost of goods sold is going to be 120 minus 30. That will be 90. Same calculation, same numbers, nothing else. Just the presentation is a little bit different, right? As you can see, everything is the same. Now everything will be exactly on the same line as well. Now we have everything lined up and ready to go. Well, again, one is the horizontal calculation. The other one is the vertical calculation. Now, as you can see, this one is more like a reporting kind of style calculation. Great, that's for the merchandising company. Now, the problem now is that we have another type of business, which is manufacturing business. So what we're going to do with the manufacturing business? We're going to create, obviously, we're going to create a new worksheet, and we're going to call it manufacturing business. So let's start with the manufacturing business. Now, the manufacturing business, we need to do some adjustments here. First adjustment will be I'm wondering, should I delete this one or no? I'm going to keep it. We don't have inventory. So then what we're selling to the customers, we're selling finished goods. Why are we selling finished goods? Because we're producing finished goods. That's why. We're producing finished goods, we're selling finished goods, end of the story. So from where I'm going to get finished goods? From the cost of goods sold then, from the finished goods inventory account. Now, do I have to purchase those ones? No, actually I have to manufacture them. I have to manufacture. And once I manufacture, those goods is going to come with the cost of goods manufactured. Once I manufacture, they're going to have their own cost. So what I'm going to do, I have to do some changes here. Debit is not longer purchases now. That will be cost of goods manufactured. And credit is going to stay cost of goods sold. So in order to calculate my cost of goods sold, I need the beginning balance plus cost of goods manufactured and that's going to give me equal to the cost of goods sold plus the ending balance. So the calculation is the same, but hold on a second, I have to change something here as well. First, it's not going to be inventory. Now we change the name. That's no longer inventory. Now become a finished goods. And the purchases are not longer purchases. That is actually coming from the cost of goods manufactured. Why? Because we have to manufacture the goods. We cannot just go and buy it. And now we don't have any more inventory available for sale. We have a finished goods available. And then we have to deduct the ending balance of the finished goods. And that's how we're going to get cost of goods sold. So the same idea, just slightly change in the terminology. But now we have a problem. If we purchase, I can easily get the cost of the purchase. Why? Because I have an invoice. On the invoice says the single price per item, number of the items that you purchase, everything is easy. Here, I have to manufacture them. So now, in order to calculate, get the cost of good manufacture, I have to see where this cost of good manufacturing coming from. And then, as you remember, for the manufacturing company, we said that they have 3 inventory accounts, and the finished goods is the last one. So what we have to do? Before we go to the cost of goods sold, I have to add a lot of columns. So first, I have to manufacture my products. But those manufacturing, they're gonna come from account which is called 1, 2, 3, 1, 2, 3. That will be 1, 2, 3, 1, 2, 3. That's gonna be called. Let's paste it here, see if it's gonna work. That's gonna be called work in process. It's not rest in peace, work in process account. From that account, we're gonna get cost of goods manufactured. When we're gonna get cost of goods manufactured? We're gonna get it when direct material, direct labor, let's leave some space here, actually, direct material, direct labor, and manufacturing overhead meet together. Manufacturing overhead. When those 3 costs meet together, and when we say our product is complete and can move to the next stage, which is ready to be sold, then they leave work in process account. But as you remember from the slides, work in process account is the second of the 3 accounts. The bottom was finished goods, before was work in process, then we have one more account. So I need to add more columns here. And let's add more. And what do I need now? I need another account, which is called raw materials. Let's see if this is gonna solve my problem. It's kind of, no. I need one more column here, and I need to delete one column here. No. So my first account in the manufacturing company will be raw materials. Why? Because I have to get the material. If I don't get the material, I cannot produce anything. I may have a labor, I may have manufacturing overhead, but if I don't have the material, there's nothing I can do. Go open the restaurant, hire the waitress, hire the cook, hire the chef, but don't buy any groceries. Don't give them any material to cook, and see what's gonna happen. And ask the clients, come and eat my dishes. What's gonna happen? Nothing's gonna happen. There's no raw material. You cannot produce even a single dish. Why? Because there's nothing. But you have everything else. Even you can put water on the stove and start boiling the water. But there's nothing. So what you have to do? You have to get the raw material. How can I get the raw material? Very simple. Go to the market and purchase them. So we need to start purchasing. Once you purchase the raw material, then you can use that raw material as a direct material. Before that, there's nothing to use. So let's see now. In the previous case, with the merchandising company, it was easy. We have one inventory account, beginning balance plus the debit equal to the credit plus the ending balance, we're done. Here we have 1, 2, 3 accounts. What that means? That means we have to do this beginning balance plus the debit equal to the end, credit equal to the ending balance 3 times. So first time we're gonna do it here, second time we're gonna do it here, and the third time we're gonna do it for the finished goods. So how can easily you remember this? So watch, actually no, listen to me and try to answer. Imagine this. You have in your pocket $5. You want to go to the metro town and you went to the with $5, there's nothing you can buy. So you need more cash. So you go into the ATM and you withdraw $100. You went to shopping, did what you did. You didn't shop obviously too much, but when you went home, you found in your pocket $20. Now the question is, how many dollars you spent in Metro Town? Any guess? 85? Okay. So that's one type of questions. How can we get this question? Very simple. Just apply the formula. Which formula? This formula. So what we're going to do? We're going to have 5 plus 100 should be equal to question mark, we don't know, plus 20. So where we are, question mark should be equal to this 5 plus this 100 minus those 20. 85. You're correct. Now let's do another calculation. And that calculation will be, you have in your pocket $20. You went to the ATM, you withdraw $200. You went to Metro Town and you spent $180. How many dollars you have in your pocket? Okay. That's a very serious accounting question, people. You have to understand. That's the level of difficulty of the accounting that we're teaching here. The other way that we can do this question is you open your fridge, and looking for milk. And you saw that there's in the jug of the milk, there are approximately 1 liter. You know, you know that your kids, pretend that you have kids, usually drinking around 5 liters milk per week. And because of the weekend, you want to cook for your daughter a birthday cake, you need 2 liters. Now the question is, when you go to superstore, how many liters milk you have to buy? Do you understand? That's the level of the difficulty of accounting. The other question that we can have, you can use so many different things here. The other option that you have is you withdraw $200 from the bank, from the ATM. You have the receipt for 150. You check in your pockets, you found $70. How many dollars you had in your pocket before you go out? Everybody agree that's $20? Okay. So you see how complex the questions are. So those are the 4 types of questions that you may have. Either you're going to ask for the purchases, either you're going to ask for the credit, which is on some instances is cost of goods sold, on some instances is direct raw material used, or in some instances can be cost of goods manufactured. Either is going to ask for the ending balance, or either is going to ask for the beginning balance when the other 3 are given. All right. So now let's do our calculation here. Let's go and do one schedule for cost of goods manufactured and see how we're going to do this schedule for the cost of goods manufactured. In order to prepare cost of goods manufactured, we have to go to Metro Town 2 times. What that means, first we have to do the calculation for the direct material used. Then we have to add directly the manufacturing overhead, apply beginning balance, deduct the ending balance, and get cost of goods manufactured. And that's how we're going to get this cost of goods manufacturing schedule. So let's start it. First, we're going to get beginning balance of the raw material. Once we get the raw material, then we're going to add the purchases. Once we add the purchases, we're going to have a raw material available for use. Okay, so far so good. So let's put the numbers that we have, because we do have some numbers. Let's use those numbers and see how it goes. Okay, we have raw materials which are 20. We purchase for 200. Now we have available 220. We decide to actually we don't know this number. Let's get rid of this number. We don't know this number. And our end balance is, let's leave it 13. So we deduct less ending balance, of which account, of raw material account, of course. Account, which is $30. And the question is, how much raw material we have used? And we're going to come with the raw material used in production. It's going to be equal to this one minus that one, $190. Now, once we have the raw material used, now we have to come up with the calculation for the working process. Now we have two options here. I can plug the beginning balance in the beginning, or I can plug it at the end. Let's go with the plug it here in the beginning. Let's start with the, now we need the beginning balance of the working process. Then we're gonna add, what we're gonna add? We're gonna add direct material use. We're gonna add direct labor, which is gonna be given to us, and we're gonna add the manufacturing overheads. Once we have those three costs, only those three costs is gonna give us a product cost for the period. Once we get those three, that will be product cost. Cost for the period. Which period? Month or quarter or year, whatever we have. Then when we add the beginning balance, when we add the beginning balance to the product cost, then we're going to have a total product cost available to move forward. Cost to distribute. Then we're going to deduct less ending balance of the working process account, and then we're going to get cost of goods manufactured. So let's fill the gaps. Let's pretend that now we have here, we already calculated that's equal to 190 coming from here. And then that 190 comes here. So let's change the beginning balance here to be 50. Under the direct labor, let's say 150, and manufacturing overhead 70. And ending balance, let's leave at 40. And now we want to find the cost of goods sold, cost of goods manufactured. So beginning balance of the work in process is 50. Actually, let's read it from here. 50. And then we have direct material is 190. Direct labor is 150 and 70. That's going to give us total product cost 410. Now the 410 actually I'm going to leave it here, and this one's going to move it a little bit on the side. So I'm going to move it. This one's going to move it here, actually right here. 50. So I have this 410, which 410 is going to come to my formula right here, which will be the calculation. And now those two together is going to give me the total product cost that I need. Now I have to change the formula here because it doesn't include everything. Let's change this formula like this. Now I have product cost to distribute her 460. Then we're going to deduct the ending balance, which is 40, and it's going to give me the cost of goods manufactured, which will be the total product cost less the ending balance, and it's going to give me $420. And let's highlight it, double space it, and make it nice and beautiful. And that's our cost of good manufactured. That's how we're preparing the schedule of cost of good manufactured. Now you have to prepare the schedule for your assignment. And remember how you prepare for the assignment because you have to do it for the midterm exam as well. Now, once we have cost of good manufactured, I can easily calculate my cost of goods sold, which now, if I put cost of goods sold, then it will become a schedule of cost of goods sold, which is right here. Now, in this case, what's going to happen is I'm going to get the finished goods. Let's change this number to be now 70. And then I'm manufacturing something which manufacturing cost in this case is 420. So that's 420. Come here, cost of good manufactured, and my ending balance is 30. That's good because we don't want to have too much available. And that's going to give me 30 here, and then left 410. That's cost of goods sold. So if I magically add this part at the end of this calculation, then will become cost of goods, schedule of cost of goods sold. That's how I should remember it. Now I'm not going to add it. I'm just showing you. Okay, I'm going to save this one. I'm going to post it. You already have this kind of calculation available for you. But anyway, I'm going to post it for you so you're going to have it available. Now let's stop this sharing and let's move to the slides again. And let's repeat this one a few times so you can get bored and sick of this repetition. So first thing, let's get the calculation for the cost of goods sold for the merchandising company again. Again, beginning purchase merchandising inventory, then we're gonna add the purchases, and then we're gonna have inventory or cost available for sale. Inventory available for sale or cost available for sale. Now, different people is gonna call it different. Then we're gonna deduct the ending merchandise inventory, and we're gonna get cost of goods sold. Now, for the manufacturing company, we cannot use merchandise inventory because we're not selling merchandise inventory here. We're producing the product. So basically, we're going to start with the beginning, finished goods inventory. Then we're going to add cost of goods manufactured because we have to manufacture those things. If you want to sell something, it's not like we're purchasing and then selling it. No, we have to manufacture it. Then we're going to have cost available for sale, which is our finished goods available for sale. Then we're going to deduct the finished goods inventory, and we're going to have cost of goods sold. So again, in every account, what you have to understand is beginning balance plus the debit, always going to be equal to the credit plus the ending balance. Now, how we're going to call the debit and credit, it doesn't change the fact that, again, beginning balance plus the debit always going to be equal to the credit plus ending balance. And then we're going to have move some items here and there to make your life a little bit more tricky. So let's start with this one. Your inventory balance for this merchandising company, inventory balance beginning was $1,000. You bought $100 during the month and you sold 300. How much you left? 800, right? Is everybody see that at 800? Now we can change this question so many times. You have in your pocket $1,000, you withdraw $100, and you spend $300. How many dollars you have? Right? We can go that direction. But it doesn't change the fact that beginning balance plus additional minus what you dispose or sold or used is going to give you the ending balance. So beginning balance plus the additional is going to give you available. Once you deduct whatever you use or sold or dispose, you're going to give you the ending balance. That's for the merchandising company. Let's see now manufacturing company. Again, to calculate, first we start with the calculating the raw material, direct labor, manufacturing overhead, and that which are used for the production. Once we calculate that, we're going to get the manufacturing cost or cost that we cost us to manufacture that product or finished goods, and then we can see how much is the cost of goods sold. So let's start first. First, we're going to set up those at the beginning. One account for the raw material, work in process, and then we're going to add finished goods. Let's start now with the raw material. Raw material, beginning balance, plus the purchases is going to give us raw material available for use. Less the ending balance is going to give us raw material actually used in production. Now, the manufacturing cost will be direct material. We're going to add direct labor, and we're going to add manufacturing overhead. That's going to give us total manufacturing cost or total product cost for the period. Now, to that cost, we have to add the beginning balance of the work in process, and that's going to give us a total work in process for the period. Once we deduct the ending balance for the work in process account, we're going to get cost of goods manufactured. What we're going to do with cost of goods manufactured? Well, that's cost the units which are already produced, they're going to move to the finished goods account with the cost that cost us to manufacture those. So there we're going to have beginning balance of the finished goods plus the cost of goods manufactured is going to give us cost of goods available for sale. We're going to deduct the end finished goods inventory, and we're going to get cost of goods sold. That's how we get it. Another perspective here, product cost. Which is the product cost? Raw material, direct labor, manufacturing. What we're going to do with that? Raw material, we're going to purchase it from outside. We're going to use them first. We're going to put them in the raw material inventory. Then from there, we're going to get the direct material, which are used for the production, and we're going to move it to the work in process account. In work in process account, the direct material is going to meet with direct labor and manufacturing overhead. And when we say our product is complete, they're going to move to the finished goods. Once the finished good is sold, it will become a cost of goods sold. How about the selling administrative expenses? They will be directly expense and go and meet cost of goods sold in the income statement. Another representation, not that we don't see enough, but let's see another perspective. Another perspective will be direct material, direct labor, and manufacturing overheads. They all together as a product cost, we're going to meet each other in the work in process inventory account. Once that work in process is completed and we have a finished goods, they're going to move to the finished goods inventory. And they're going to stay there until somebody comes and say, I want this product. Once somebody says, I want this product, we're going to say, okay, that product is yours. Only left is you have to pay for it. So he decided to pay more than the cost, and now we have cost of goods sold, and we're getting what we get from the customer. Now we're going to have the sales administrative expenses during the period. Those directly going to expense them. So what that means, we have to make sure that we generate enough from the sales, we generate enough to cover our cost of goods sold plus the selling administrative expenses. Otherwise, we're going to start losing money, and we don't want that. Let's do one question all together now. Let's start with this question. What I'm going to do now with this question is trying to get it to work, but it doesn't help me. Let's try again. I'll try harder. These slides, for some reason, it doesn't give me opportunity to copy it. Anyway, yeah, it doesn't give me that opportunity. Anyway, on the break, I'm going to try work for this. So beginning raw material was $32,000. During the month, we purchased 276 of the raw material purchase. Account at the end of the month revealed that 28,000 of the raw material was still present. What's the cost of direct material used? 280. Everybody agree with that? The other way that you can do is think about it. Beginning balance is 32. Ending balance is 28. Is the ending balance higher or lower than the beginning balance? Lower. If it's lower, so watch this. If the beginning balance is 32 and ending balance is 32, how much raw material we have used? No. Beginning balance is 32, ending balance is 32. We purchased 276. How much raw material we used? 276, correct? Whatever we purchase, or the other words, whatever we purchase, that's how much we used, correct? So if the ending balance is less than the beginning balance, that means we use whatever we purchase plus we reduce the beginning balance, correct? Are you following my logic? So what's the reduction of the beginning balance? From 32 went down to 28. How much is that? 4,000. So what that means? We use what we purchase plus 4,000 more. So what that means? 276 plus 4, how much give you? 280. Make sense? That's another way to calculate it. That's why in some managerial accounting, there's so many different ways that you can come up with the number. And the logic, it's always going to be correct. As long as you follow this. Make sense? Is this make sense? Or are you confused now? Vicky is fine. Okay, let's go then. Let's try another one. Again, beginning balance 32 plus the purchases 308 minus 28, 280. Or 276 plus the difference between 32 and 28, 4,280. Move to the next one. Now, what's happened in the next one? Direct material went to the manufacturing overhead. In the manufacturing overhead met direct labor and the factory overhead, which is 180. Now the question is, how much is the total manufacturing cost for the month? So what we have to do, we have to get all those together, correct? 835. So let's see. 835. So we get 280 plus 370 plus 180, 835. So now what's we going to do with the 835? Well, then we're going to move to the next question. Now the 835 is the direct material direct labor for the period. Now we have beginning balance, which is 125. And at the end of the period, the finished goods remaining in the work in process account is for $200,000. Now, how much is the cost of the goods manufactured during the month? Amanda, you agree 760? Okay, maybe. Why maybe? You're not calculating? I don't calculate. Okay, let's see if that's the case. Not this one. Let's go to this one. Beginning inventory, 125 plus 835, 960 minus 200, 760. Now what's going to happen with the 760? 760 obviously is going to go to the next account, which is the finished goods, which is the final one. Now the beginning finished goods 130. We manufacture new products for 760. At the end of the month, we count the inventory and we found that we have 150,000 worth for the goods. How much is the cost of goods sold? 740. Now, the other thing that I want you to think is during the month of this month, did we sold what we produce? No. Is this good for the company? Everybody agreed that this is not good for the company. Why? Because we didn't open the company to produce products. We opened the company to sell the products. So if we cannot sell what we produce, that's not a good thing. Make sense? So again, that will be beginning finished goods was 130, cost of good manufactured the month 760, and then available 890 minus 150 ending balance 740,000. So for the different purposes, again, different classification. The one thing that I want you to understand is all the costs already happen in the company. I cannot change the cost. I cannot do anything. So any calculation that I'm doing on any different classification always going to bring me to the same amount of the cost. Now, for different purposes, different classification. For the external financial reporting, we're going to have this product cost, which is inventorable, and period cost. Product cost will be direct material, direct labor, manufacturing overhead. Period cost will be non-manufacturing cost, which is marketing, selling, and administrative cost. How the costs behave based on the behavior of the cost, we're going to see in a few minutes. We're going to have two categories, variable cost and the fixed cost. So we're going to get all these costs here, product and period cost, and we're going to chase them how they behave. And based on their behavior, we're going to classify them as a variable fixed cost. Now, the other thing is assigning the cost to the object. We can have two types of cost, direct cost and indirect cost. And for decision making, we're going to see there's a different cost, differential cost, sunk cost, opportunity cost, all those different interesting costs. Let's go now with the classification predicting of the cost. How are we going to predict the cost? Now, for the In order to predict the cost, we are going to separate them on only two type of costs. One is the variable cost, the other one is fixed cost. Interesting with the total variable cost. Both costs are going to behave in total and per unit. For the total, variable costs in total always and always going to change when the level of activity changes. One thing I want you to remind you is cost is mathematical function of two variables. One is the quantity, the other is cost per unit. If you change the quantity, total cost changes. Variable cost behave in that way. Fixed cost in total stays the same. So let's see now on the cost behavior. Pure variable cost will be grocery. Let's go buy some potato. You want to cook something with the potato. You're going to the store, superstore, and seeing the potato, what costs like $1 per pound. If you buy 2 pounds, you have to pay $2. If you buy 3 pounds, you have to pay $3. You may say, oh, too expensive. I'm not going to buy a potato. I change my mind. I'm going to buy some apples. So now you don't buy potatoes. So technically, you don't buy. Well, forget about the bulk potato. Bulk potato, that will be fixed cost. If you're going and spend for 10 pounds, $7, that will be more like a fixed cost for the entire bag. But now, if you go in that, if you do in that case, now if you measure it in the bags, then the variable costs will be per bag. Make sense? So now the depends how many bags you're buying, that's going to drive the cost. If you're buying 10 bags, if let's say the bag of potato is $8 and you're buying 10 bags of potato, the cost will be $80. If you decide not to buy a bag of potato, it's going to be zero. Right? But now, watch this. The other thing is, if you buy, now let's go to the fixed cost. Let's go with the fixed cost because we got the bag of potato. I like this example. Let's stay with the bag with the potato. But if you buy the bag of potato, it doesn't matter which bag you want to buy. The cost will be the same. Make sense? Every each bag of potato is going to cost you $8. So in that case, the bag of potato is the fixed cost. Now, let's go to the variable cost per unit. Variable cost per unit always going to stay the same, which is for our unit is the bag of potato. So the bag of potato always going to stay the same, always going to be $8. So it depends on the number of the bags, that's going to drive the cost up or down, variable cost. So variable cost is driven by different drivers. One driver can be units produced. More you produce in the manufacturing company, more you're producing, more variable cost. Less you're producing, less variable cost. Machine hours can drive the variable cost. More machine hours you're using the machine, more cost. Less machine hours, less cost. Miles driven can drive the variable cost. More miles you drive, more cost. Less miles, less cost. Labor hours, more you worker working on the labor, more cost. Less cost. Fixed cost. Now the fixed cost, however, stays the same. Example for the fixed cost will be the entire bag of potato or rent. So first, let's talk about rent. Rent is the fixed cost. No questions about it. In total. Why? Because for the month stays the same. Bag of potato is a fixed cost. Why? Because each bag of potato is the same. If you buy a whole bag of potato, regardless which bag of potato you buy, it's going to be the same. Now, let's see the unit cost. Now, when you pay the rent and one person leave in that apartment, let's say you're paying for one bedroom, you're paying $2,000, and one person only live in that one bedroom apartment, how much is the cost per unit or per person in this case? Again, one bedroom, $2,000 you're paying, one person living in that apartment. How about if that person find himself a boyfriend or girlfriend and two people start living there? What's going to happen then? Cost per person. Is it? I'm not talking about the total cost. I'm talking about cost per person. How much is the cost per person now? $1,000. The total rent is going to be $2,000 for the apartment. But if two people living there and cost per person is $1,000. So we reduce the cost per person drastically. How about it? Four people start living in that apartment. How much will be the cost per person now? $500. So what's our incentive here? To put more people to live in that apartment, correct? So now let's move the same idea with the bag of potato. Remember bag of potato. We say bag of potato. Once you buy a bag of potato, that's your fixed cost. Now, if you have in the bag 10 potatoes, if you pay $8 and you have in the bag only 10 potatoes, how much is the cost per potato? What if you have in the bag 20 potatoes? The cost gonna go down. Make sense? Do you understand this logic now? Okay, we're going to come to this variable and fixed cost in the chapter 3 in a few minutes, but let's finish now this. Let's go with the relevant range. What is a relevant range? Relevant range is the range of activity, where the variable cost per unit stays the same, in total goes up or down, depends on the usage, and fixed cost in total stays the same, and per unit goes down. So the example here is this. Imagine I'm not teaching this course for the Douglas College, but I'm going to Douglas College and say, can I rent a room for this course? And they say, yeah, you can rent a room. But, and I'm asking, how much is the cost? They say that 2,000 is the cost. But there's a catch. You can, in that room, there will be only 20 chairs, and you cannot have more than 20 students in that room. If you want more students, if you have on the waiting list students, then you can rent another room, but the next room available, next capacity of the room, next relevant range is with 40 chairs now, but the cost is double. So now you have to pay me $4,000. Make sense? So let's say I'm staying on the 220 people with the 20 chairs room. I'm staying in the first scenario. I'm charging students only $200 for this course. So basically, I'm generating $4,000, paying the $2,000 rent to Douglas College, and I'm getting $2,000. Now, the question is, if I have 5 students on my waiting list, should I rent another room? The biggest room. Why? What's going to happen? I have to pay additional $2,000, but I'm going to generate only $1,000. So I'm losing $1,000. Make sense? So what will be the minimum number of the students that I have to have on the waiting list in order at least not to lose money? Does that make sense? So if I have 10 students, that's going to give me $2,000. I'm going to pay additional $2,000 rent. So I'm going to be neutral. No, I'm charging the same amount. 200. So on the cost behavior, again, we're going to come back and do this one. Variable cost. In total, changes with the changes in the level of activity per unit stays the same. Fixed cost in total stays the same per unit, always goes down. Let's do this quick test. Which of the following costs will be variable with respect to number of cones sold? So based on the numbers of the cones sold only, which one is variable, which one is fixed? At this Baskin Robbins shop. So first one, cost of the lighting in the store. Is this a variable cost or fixed cost? In respect to the number of cones sold, fixed cost. Okay, it doesn't matter how many I'm going to sell, the light's going to be on. End of the story. How about the wages of the store manager? Fixed cost. Okay, cost of the ice cream, variable. More I'm selling, more cones I'm selling, more ice cream. That means more ice cream goes. How about the cost of the napkins for the customers? The same variable cost. Okay, excellent. Okay, so on assigning, let's assign cost to the object. We have two options here, direct cost, indirect cost. It's very simple. Which cost is direct? The one who can easily trace to the object. In other words, if the cost has adjective direct in front of the name of the cost, is direct cost. If it doesn't have adjective direct in the front of the name of the cost, is indirect cost. Examples for direct cost will be only two examples. I'm sorry, there's no other examples. That will be direct material and direct labor. Why? Because they have adjective direct in front of the cost. End of the story. Indirect cost. Anything that don't have adjective direct is indirect cost. Then we're going to have indirect material, indirect labor, manufacturing overhead, and all the other things that will be indirect cost. Let's go with the decision making. Now we start making decisions. For every decisions, in order to make a decisions, we need to have at least two available alternatives. If you have only one alternative, there's no decision to make. So which cost we're going to consider? Only the cost and benefits which are different between one option and the other option. Anything which is the same should be ignored. Let's see this one. It's an old example, so don't get snowed by the cost. You have a job paying 1,500 per month in your town. Then you have an offer from the closest town for $2,000 per month. But you have to commute 300, and the commute's going to take you $300 per month. Based on the cost and the benefits that you're getting, should I accept the job or not? Why? Because the additional money that I'm going to get, $500, are enough to cover the commute, and I'm going to have 200 extra. We're not considering anything else. We're just considering the cost in this case. Only quantity. Quality, no. Forget about quality of life. There's no quality of life. Quality of life. We have to work first. Sorry. So opportunity cost. What's the opportunity cost? Opportunity cost is the potential benefit that is given up if one alternative is selected instead of the other. For example, if you not attend the college, you can earn 15,000 per year. Now, but you're attending the college. So that means you have to consider those $15,000. So that means if you go to the college, when you get out of the college, at least you should get $15,000 more in the first job that you get. So the interesting thing with the opportunity cost is the cost that you don't have to pay. Nobody pays opportunity cost, but you have to consider it. Sunk cost is the cost that already happened. There's nothing you can do about it, so stop crying about it. Move on. For decision making, you just don't even consider it. So, for example, you bought automobile that cost $10,000 2 years ago. The $10,000 is sunk cost, whether you drive it or park it or trade it or sell it or don't use it. Sunk cost. You cannot go back and change the cost. It's already gone. Let's see this quick check. Pretend that you want to go to Portland for a concert. You have two options: drive or take a train. Cash is not your problem. Quality of life also. Is the cost of the train ticket relevant for your decision? In other words, should the cost of the train ticket affect the decision whether to drive or to take the train? Absolutely, yes. It's one of the decisions, right? So yes. Now, again, same scenario. You want to go to Portland to watch this concert. Option one, drive. The other one, to take the train. Cash, again, is not a problem. Is the annual cost of the licensing your car relevant for this decision? No. Why? Because you already pay for it. How many of you travel outside of Canada? Is there anyone who travel outside of Canada? I'm looking for people who have a car, and person who pay to ICBC insurance, annual insurance, drive the car, and at the same time went for vacation outside of Canada. Is there anyone here in the chat room or in the Zoom? Anyone? Yes. So for those of you who have a car, who paid the ICBC insurance and went for vacation, have you ever experienced this? You're going to the airport and there's an agent like approaching you from ICBC and asking you, "Excuse me, are you going on vacation?" And you're saying yes. For how many days? For 10 days. So that means you're not going to drive your car, correct? And you say, "Yes, I'm not going to drive here." Then can you come with me? I'm going to give you a refund for 10 days of not driving your car. Have you ever had that experience? Would you ever have that experience? No. So that's a sunk cost. Not likely, right? So the last question, tricky question, careful with this question. I want you to get it right. Suppose that your car could be sold now for $5,000. Is this a sunk cost? What is it? What kind of cost is it? It's a tricky question. Is it cost at all? Think about it. You're supposed to sell your car now for $5,000. Is this a cost for you? No. It's a money coming in, people. It's not a cost. All right? Since when the money coming in become a cost? They're not, right? Yeah. Again, the initial price of the car it's irrelevant, right? We're looking forward. So the cost, summary of the cost classification. For the financial reporting, we have period and product cost. Predicting the cost behavior, variable, fixed. Assigning cost to the cost object. Direct, indirect. Decision making, we have opportunity cost, differential cost, sunk cost. And that's where we're stopping with the chapter 2. And now we can continue with the next topic.